Hello and welcome to our latest Insider interview. Today in the studio, I have with me Mike Seidenberg, who is fund manager of the Allianz Technology Investment Trust. Mike, great to have you today.
Great to be here.
So Mike, could you start off by telling us about your investment process? There's obviously lots of technology companies to choose from the household names such as Amazon, Apple, etc., to smaller companies that could in the future become tomorrow's winners. Sure. So what types of companies do you look at?
Well, our process is really one around creating a mosaic, right? And that mosaic has a variety of inputs. Not only do we talk to the company, which can be valuable, we talk to system integrators, we talk to consultants, we talk to chief information officers, private companies that may be competitors or someone in an ancillary space. The goal here is to really understand the subsector that we're looking at within the technology universe, and then just really drill down. If we like the subsector, drill down to the actual company we want to invest in. And that's where things like management, things like operating model, which lends to operating margins, all of that starts to come into play. So, I often tell people, it's a little like being a detective in that we're looking at various bits of information across the investment universe in order to figure out the companies we want to invest in. And on top of that, we obviously have a macro view. So there are some companies that we might look to in a given environment from a macro perspective that maybe aren't applicable in other macro environments.
You mentioned subsectors. So could you talk us through what are the main subsectors that the investment trusts invest in? And could you name some stock examples?
There are a variety of subsectors or there are thematic sectors that we look at, whether it's cybersecurity, which, everybody that's listening to this today probably has some exposure one way or the other with either being breached or someone trying to breach them. Look, that pain point is felt by both consumers, but where the real dollars are in enterprises, right? Businesses trying to thwart a cyber attack. Interestingly enough, not only are our lives becoming more digital, and that's both consumer and businesses, but also we're seeing the adversaries are increasingly sophisticated, right? So it's nation states versus 5 people trying to hack into a high street retailer. A good example there would be a company like CyberArk, where they started solving a particular problem around server access, which is one of the challenges. If you can get, I don't want to geek out on you too much, but if you can get access to a server, you can do a lot of malicious things. So they started in that particular space at a really robust solution, but now that they're applying that solution to cloud offerings, right? Whether it's, cloud workloads. And that's a good example of a company that had a really good solution and was able to develop another solution for a different pain point. That would probably be a good example in the cyberspace. Things like business application software. A good example there would be a company called HubSpot, which is kind of focused on small and medium businesses. And the reason why we like their business, besides taking share from some of the incumbents, all unified data. So they haven't done a lot of acquisitions, and therefore, as they start thinking about the applicability of artificial intelligence to their business, it's very applicable because they have a unified data structure, which really leads itself to being able to use artificial intelligence effectively. I mean, there are lots of different examples. There's a couple. I'll pause there. If you need more, by all means, let me know.
And when investing in technology, there's always the risk of overpaying. So how do you manage to buy at a sensible valuation? Is there a particular valuation metric you view more important than others?
Well, ultimately, if you're a business and you're not generating positive free cash flow, you're not a very interesting business to me. So that isn't to say that there aren't companies that have been successful that haven't done that. But from our perspective, we really look at a business like, what does that business model look like at scale? And what do those returns look like? What is the margin structure which is going to generate that free cash flow? Depending on the life cycle of the company, we will use varying metrics. For example, in subscription software, whereby you're incurring the costs, yet you're only recognizing a small fraction of that revenue, those companies can look really unprofitable at a given given point in time as they're growing, just because of the way the accounting's done. So our job is to really look at a variety of metrics depending on where the company is in their maturation process and what sector it is, and then come up with good risk reward. Because ultimately, for our investors, what we need to do is make good risk reward decisions.
The technology sector, it's had a really strong run since the beginning of last year. So where are you now finding the opportunities? What have been the latest changes made to the investment trust?
I like to remind our investors where we really think about it is the journey of investing in technology, which is a multi-year journey. At the end of the day, our job, despite the current run, is to figure out companies that are solving difficult problems, that have an ability to sell something to companies to solve those problems, and then have a margin structure that is representative of operating margin that will really generate those free cash flows. So the sector was relative to where we saw post the pandemic, but remember, it's relatively cheap to kind of some of the valuations that we saw leading into the pandemic. So I think overall, given the variety of macro headwinds, I think technology stocks on average are pretty reasonably valued. There are a few things that might get us more optimistic, and there are a few things that will probably make us a little more pessimistic. But generally speaking, we try to own businesses on their own for a very specific reason. Despite a macro, we think that they should execute well and create long-term shareholder value.
Now, are there any particular sectors or specific companies you could name, either existing holdings or new holdings over the past couple of months?
We started to look at actually a UK-based company that's in the security space, Darktrace. Interesting business, followed it when they went public, probably didn't meet our criteria for investing, and took a fresh look at it earlier this year, liked what they were doing, liked the space they were in. So that's probably a good example of a fairly new position for us.
You mentioned that part of your investment process is looking at the wider macroeconomic backdrop. With the prospect of interest rate cuts, they may happen in the US this year.
Sure.
Would you make changes to the portfolio in advance of that?
Well, interest rate cuts overall should be good for technology companies, especially because some of them are kind of these longer duration assets. We are anticipating a number of cuts. It's not something that I think will materially change the portfolio near term, but it's something that we think about on a multi-year journey. Kind of where do interest rates go? Inflation's been more stubborn than investors ever kind of thought it would be. I think that a lot of the cuts will be reasonably anticipated.
The majority of the investment trust is invested in US listed companies. I don't think you have any exposure to China, which has benefited performance over the past couple of years. Given that China's stock market, it's been out of form, valuations looking cheap, is this an area you're looking at?
Candidly, it's not something that's high on our priority list. I think that we, as a trust, had been investing in China since 2012. We were really early to the China opportunity. Conversely, we were really early to the change in the political regime there, which really impacted the capital markets and stocks. So unless we saw a fundamental change to the rules whereby the government's currently playing by, I think I'd probably be better served for our investors not investing in China right now.
Mike, thank you very much for your time today.
It's great being here. Appreciate the questions.
So that's it for our latest Insider interview. Hope you've enjoyed it. Please let us know what you think. You can like, comment, and for more videos, hit that subscribe button. And hopefully, I'll see you again next time.